Welcome back to the deep dive. Today, we're plunging into something that sounds pretty technical on the surface. We're talking blockchain, decentralized finance, DeFi, you know. But the thing is, it has these profound real-world implications for literally billions of people.
Billions is right. It's a huge number.
Yeah, I mean, we're looking at something like 1.4 to 1.7 billion adults around the globe who just don't have access to, well, normal banking.
Basic financial services, yeah.
And this isn't just about, like, having a bank account. The kicker is it's about potential. It's about economic participation, entrepreneurship being stifled, empowerment being held back simply because traditional banks aren't there or aren't accessible. So, okay, let's unpack this. Let's try and understand how blockchain and DeFi are actually emerging as maybe powerful solutions to bridge this huge financial divide.
It's a massive challenge, absolutely. And you've really hit on why this is such a timely conversation. Traditional banking, I mean, for all its stability, it does have significant limitations for a lot of people. It's all built on, centralized trust, heavy regulation things, central banks, the Fed, all those intermediaries.
Layers and layers.
Exactly. And while it's meant for stability, it often leads to inefficiencies, high transaction costs, really slow processing time sometimes, and critically, like you said, limited access in many regions. And, the 2008 crisis wasn't just about fragility. It exposed a deep distrust in those centralized players.
Ah, interesting point.
And DeFi sort of directly addresses that distrust, almost by design.
And that takes us squarely to blockchain, right?
Yeah.
The kind of fundamental building block for all this. People might know it as this immutable distributed ledger, basically a permanent shared record. Trust isn't from a bank. It's from, like, the math, the cryptography, and everyone agreeing across the network.
The cryptography and the consensus, yeah.
But here's where it gets really interesting for me. How do all those computers actually agree on what's true without a boss, without a central authority? That's these consensus mechanisms, right? The rules the network follows to check transactions securely. You've got proof of work, like Bitcoin started with computers racing to solve puzzles.
Right, the energy-intensive one.
Yeah, and then proof of stake, which Ethereum's moved to, where people lock up their crypto, they stake it as collateral to get chosen to validate.
Exactly. Those mechanisms are what secure the whole thing.
Makes it trustworthy without the middleman.
Precisely. And it's important to grasp that blockchain isn't just one thing. There are different types for different jobs,
Okay.
You have public blockchains. Think Bitcoin, Ethereum, totally open, transparent, anyone can join in. Decentralized.
Well, ones most people have heard of.
Probably, yeah. Then you've got private blockchains. These are permission access is restricted. Think businesses using something like Hyperledger for internal stuff. More efficient, faster maybe, but less transparent, less decentralized.
Makes sense for corporate use.
Definitely. And then there's a mix. Hybrid blockchains. They combine bits of public and private. You get flexible control, keep some data private, share other bits publicly, good for supply chains, maybe healthcare, where you need that kind of selective sharing.
So different tools for different needs.
Yeah, exactly. Depends on what you need. Transparency, control, speed. And to make all this work with the real world, especially for DeFi, you need something called oracles.
Oracles, like data feeds?
Kinda, yeah. They're vital bridges. They connect the smart contracts on the blockchain to real-world data price feeds, weather data, whatever. They make DeFi applications, well, functional and accurate. The Pith network is a good example. It's a first-party oracle, meaning the data comes direct from the source, like trading firms.
Not through another layer.
Right. So it's super fast, super accurate. It kind of democratizes access to data that used to be locked away behind paywalls.
Okay, so if oracles are the data pipes, then DeFi is the whole new financial world being built using those pipes, right? Recreating lending, trading, insurance, but without the banks and brokers in the middle.
That's the core idea. It happens on these transparent, decentralized networks.
And it's permissionless, you said. What does that really mean in practice?
It means essentially anyone with a digital wallet can potentially use it. You often bypass the traditional KYC/ML checks, at least for basic access.
Know your customer, anti-money laundering.
Right, which makes DeFi inherently borderless, and that's potentially massive for financial inclusion.
For you listening, this could mean access to financial tools that were just out of reach before, geographically or because of cost, no matter where you are.
And this links directly to tackling financial exclusion. PwC talks about 4 key areas: access, quality, trust, and usage. DeFi could improve all 4.
Okay, let's break those down. Access.
Access is huge, especially cost. Look at cross-border payments, remittances. blockchain solutions, often 0 to 1% fees. Traditional finance, you're looking at average maybe 2.7 to 3.5% sending money between, say, the US and Colombia or Kenya.
Wow, that's a big difference.
It's a huge difference. It lowers that affordability barrier dramatically for people who really need every cent. More money actually reaches the family. That changes daily life.
That difference in fees isn't just numbers, is it? It's food, it's school fees, it's stability.
Absolutely. Then there's quality. DeFi brings speed. Decentralized public networks can settle cross-border payments in, like, seconds. Quick access to funds for daily needs, emergencies.
Seconds versus days sometimes.
Right. And you get innovative solutions like stablecoin wallets in Argentina. They give savers a digital asset that helps hedge against their really high inflation. It's a refuge.
A practical tool for a specific problem.
Exactly. And interoperability is key too. Public blockchains set universal rules, so different platforms and assets can potentially work together, breaking down those old financial silos.
Okay, access, quality. What about trust? That seems counterintuitive without a central bank.
Well, the trust comes from the tech itself. Security and privacy are kind of baked in. Advanced cryptography, secure consensus. It makes it nearly impossible for bad actors to tamper with the data on the network.
Nearly impossible.
Well, yeah, nothing's absolutely foolproof, but extremely difficult. Plus, transparency. You can use blockchain explorers to track transactions. That builds trust.
Yeah.
It even gives regulators potential insight into solvency or illicit flows.
So, okay, let's translate this. What does this mean for you, the individual listening? How do these features turn into actual benefits?
Well, you could potentially earn interest directly without needing a bank as the intermediary. Access loans differently. Trade assets peer-to-peer.
Can you give some examples, like specific DeFi apps?
Sure. For lending, you've got platforms like Aave. They're known for diverse crypto lending, even these things called flash loans.
Flash loans.
Yeah, uncollateralized loans taken and repaid in the same transaction block. Super fast, used for complex trading strategies like arbitrage. Shows the speed of DeFi. And then there's Compound. It uses algorithms to set interest rates based on supply and demand and liquidity pools. Users supply assets, earn interest, borrowers take loans. It's like a democratized money market.
Okay, and for trading, people talk about DX, right? Decentralized exchanges.
Exactly. Uniswap is maybe the most famous example. It's open source. You keep control of your own crypto assets.
So not your keys, not your coins doesn't apply in the same way.
Right. You hold your keys. Anyone can list a token, theoretically. And there's no central company running the show, just code. They charge a small fee, like 0.30% on trades.
How does it work without a company matching buyers and sellers?
That's the cool part. Automated market makers, or AMMs, you trade against a pool of assets locked in a smart contract, and an algorithm sets the price based on the ratio of assets in the pool.
So you're trading against the pool, not another person directly.
Essentially, yes. So the core ideas are using assets as collateral for loans, algorithms finding interest rates, and these AMM pools for trading. It's a totally different financial toolkit.
It sounds revolutionary, but it also sounds complicated and maybe risky.
Oh, absolutely. Well, the promise is huge. We have to be realistic about the hurdles. Complexity is a big one. Vitalik Buterin, Ethereum's co-founder, even said, people should probably stay out unless they really understand what they're doing. It definitely deters mainstream users.
That's a pretty strong warning.
It is. And then there are the risks, real risks,
Okay.
technical ones, like bugs in the smart contract code.
Bugs that could be exploited.
Yes, malicious actors can exploit vulnerabilities. We've seen hacks. There are also risks like blockchain outages. Solana had issues, making things inaccessible. And critically, if you lose your private keys, your password, essentially. Your assets are gone. No bank helpline to call. That's it.
Oof. That's a big difference from traditional banking.
Huge. And there are economic risks, too. If you provide liquidity to a DX, you face impermanent loss.
Impermanent loss.
Yeah, it's where the price of the assets you've pooled changes significantly,
Huh.
and you end up with less value than if you just held the assets separately. It's complex.
Okay, technical risks, economic risks. What else?
The digital divide. Simple as that. DeFi promises accessibility, but if you don't have reliable internet, you can't participate. This hits historically marginalized communities hardest. And, some criticize the DeFi industry for not pushing harder for things like broadband expansion to actually deliver on that inclusion promise.
It does sound almost too good to be true sometimes, doesn't it? And yeah, that's usually where the red flags, or at least the yellow flags, start waving. So given these challenges, the complexity, the risks, the digital divide, How does that square with the big vision of financial inclusion? It feels like a bit of a disconnect.
It's definitely a tension.
Eh.
And the regulatory landscape adds another layer of complexity, right?
For sure, you hear some calls to just ban crypto entirely.
Right. But then you see U.S. regulators actually allowing banks to custody digital assets now. Visa, MasterCard, they're supporting digital transactions.
So it's not black and white. It's evolving, kind of messy.
Very much so. It's this cautious, sometimes contradictory integration into the mainstream. And what's really fascinating now is looking at where adoption is actually happening. The geographic trends are shifting in ways you might not expect.
Oh, where are we seeing the most action?
Well, the 2023 Global Crypto Adoption Index had some surprises. It's actually developing countries often leading the charge in DeFi.
Really? Not like the US or Europe.
India is #1 globally in DeFi adoption, #1,
Mhm.
and second in DX trading volume. This is despite having really strict regulations like a 30% tax on crypto profits.
Wow, so adoption despite the rules.
Exactly. Shows strong grassroots demand. Nigeria, Indonesia, huge jumps in DeFi adoption ranks, up 14 and 13 places.
Yeah.
In fact, 5 of the top 10 DeFi adoption countries are in Asia: Indonesia, India, Thailand, the Philippines, Vietnam.
So Asia's a major hub.
Definitely. It suggests a real reshaping of financial activity, maybe finding alternatives where traditional finance hasn't fully served needs.
What about other regions?
North America's DeFi share is actually declining. Probably a mix of regulatory uncertainty and the recent bear market hitting harder there.
Okay.
Latin America shows high crypto use overall, but often more for hedging against inflation. Think Argentina, Venezuela. It's a survival tool, maybe less focused on complex DeFi plays for now.
Using stablecoins, like you mentioned earlier.
Precisely. Europe Central, Northern, Western is seeing growth. The UK ranks high, likely helped by having clearer regulations compared to some others.
So connecting this back, it really does seem like DeFi's promise of inclusion is taking root fastest, where traditional systems have left gaps, right? It's directly impacting lives.
That seems to be the pattern, yeah. Where the need is greatest, the adoption, even with hurdles, is strongest.
And it's not just individuals. You mentioned banks are starting to get involved, even if cautiously.
Right. That quote, if financial institutions embrace blockchain, they need to rethink their business model, feels very true.
We see PayPal offering crypto custody now.
And maybe even more significantly, look at central banks. Over 80% are working on central bank digital currencies, CBDCs.
Like China's digital yuan pilot.
Exactly. That's a huge step. Integrating digital assets right into the core financial system. It could offer a more trustworthy, government-backed alternative to current stablecoins.
And that could fundamentally change how you, listening, interact with your national currency down the line.
Absolutely. So for you, the listener, this isn't just abstract economics. How could you actually engage with DeFi if you wanted to, carefully?
Yeah, what are the entry points?
Well, probably the simplest way people start is earning yield. Putting stablecoins, digital dollars like USDC or USDT, into lending protocols like Compound, the yields can be attractive, sometimes hitting, 10, 15% APR, way more than a savings account. Plus, you might get extra governance tokens.
Giving you a say in the protocol.
Potentially, yeah. Another route is providing liquidity to DKEXs like Uniswap. You put up a pair of assets, say ETH and USDC, into a pool.
And you earn fees from trades in that pool.
Correct. You're basically acting like a mini market maker.
But again, with risks, right? Like
Yeah.
that impermanent loss thing.
Definitely. Comes with risks.
Yeah.
Volatility, the
Yeah.
technical risks we mentioned. It requires some tech savviness and a clear understanding of what you're getting into. Think of it like venturing into a new financial frontier. Could be rewarding, but there's uncharted territory.
So zooming out, we've really walked through a major shift, haven't we? From traditional banking, reliant on all those intermediaries, to this potential new system built on distributed networks, aiming for greater financial inclusion. It's complex, it's messy, it's evolving super fast.
It really is.
So what does this all mean for you? It means new possibilities are opening up, how you manage money, how you invest, how financial services might just become more accessible for everyone, everywhere. It feels like it's about more than just faster payments. It's touching on economic empowerment globally, potentially impacting billions. This has been quite the exploration. We've gone deep into blockchain, DeFi, and tried to uncover the potential beyond just, crypto prices going up and down.
The speculative side, yeah.
These technologies seem to be fundamentally changing how money moves, how services are accessed, and maybe who gets to participate in the global economy.
The long-term impact is still playing out, obviously. But what's undeniable is that this space is constantly evolving, constantly pushing boundaries in finance. It's redefining what financial inclusion could even look like.
Absolutely. So as you think about all this, maybe ask yourself, if this transformation continues, what could a truly inclusive, truly equitable financial system actually look like? And how might that change the everyday lives of billions, maybe even your own? Keep exploring, keep asking questions, and keep diving deep.